Morning, everyone. Apologies for the delay in getting live this morning. Few technical issues which are beyond me, I'm afraid. A bit of a technophobe. So welcome to today's shortish webinar on share valuations. My name is Clive Howarth, Associate Director here at ETC Tax, and I promise you this is the last of the scary slides. So what we're going to look at. We need share valuations for a number of reasons. You'll be familiar with quite a lot of these. Exiting a shareholder from the business, either as a result of a dispute or wanting to retire, etc. Divorce, quite a common one. Share schemes for employees, important to get valuations done and agreed for those. Of course, IHT on estates, on death, gifts into trust, and gifts or sales to relatives where maybe capital gains tax or inheritance tax might be an issue. We've got different methods of valuing shares. By reference to maintainable earnings, which is commonly used for trading businesses, and I would say by far the most popular method of valuing. What HMRC will look at are recent transactions, if there are any. Obviously, they're going to look at if there was a share sale within 6 months ago and now you're wanting a different valuation. They'll want to know why there's a difference in value. When we're looking at family investment companies or property investment companies, usually you'll just look at the balance sheet value, provided the properties have been uplifted to fair market value. That will provide you with a pretty good idea of what the shares are worth. Occasionally, a minority shareholding might be based on an expected dividend yield. In practice, it's seldom used, but it sometimes is. Where you've got different classes of shares, and one class of shares is a minority, but always gets, let's say, a £10,000 a year dividend, then the discounted value applying, huge discounts to the share price might be unrealistic, and HMRC would probably argue that the share price should be more reflective of what the expected dividend is on a yearly basis. So as I've said, maintainable earnings is by far the most popular. So how do we arrive at maintainable earnings? Well, they're simply the profits that a company can reasonably be expected to make year on year. The maintainable earnings figure is on an EBITDA basis, so we add back various items, interest, depreciation, etc. And we add back extraordinary items, excessive remuneration, one-off redundancy costs, etc. You can, of course, counter that with deductions, where in a lot of cases, and in the example we'll come on to later, in quite a lot of trading companies, there won't be directors' remuneration in there because they'll just take a small salary and the rest is dividends. So you put an adjustment in there to put a salary in for the directors. And it's usual to use a weighted average. Later years are more indicative of future profit trends than earlier years. Not always, but usually I would say that's the case. So having got to a maintainable earnings figure, what next? So to the maintainable earnings figure, we apply a profits multiplier, a PE ratio. The PE ratio I've put will be, but can be by reference to listed companies operating in the same sector. But then you discount that heavily excuse me, to reflect the more diverse activities of a listed company compared to a private company. Sometimes there isn't a comparable company that you can look at, so you basically got to use a bit of judgment to say, well, what would a private investor look to receive as a return? We'd look at probably a multiplier of somewhere between 3 and 6, depending on what sector it is and the type of business, etc. So once we've established the PE, we can then apply that to maintainable earnings figure to arrive at the enterprise value of the business. In addition to that, if there is surplus cash in the company, this can be added to arrive at an equity value and overall value for the company. I mentioned discounts before. This is a table that the ACCA produced. As you can see, technical fact sheet 168. It says in relation to property companies, but I've used it for trading companies without much complaint from HMRC, I have to say. There's a range of discounts there, and obviously the disclaimer here is that each case is looked at on its own merits, and if you've got two 50-50 shareholders, either two brothers or husband and wife or whatever, you're unlikely to get a 15 to 25% discount. In some cases, there are two unrelated shareholders who have 50-50. Now, if there's no casting vote, then you will be able to apply maybe up to a 25% discount there. But if one of those shareholdings has a casting vote, then you treat that as a majority holding, and obviously the 5 to 10 discount would apply to that. Obviously, very useful discounts, particularly when we're looking at share schemes for employees, because they are usually minority interest that they'll be getting as either options or shares. So, an example of one that we've done relatively recently. Here we looked at the maintainable earnings for the 2 years to March 2024. Those were the profits per the accounts. As you can see, we've made adjustments there for the depreciation. Entertainment was added back, other bits and pieces. And as you can see, the two directors effectively, it was husband and wife, director, company secretary, hardly anything in there for directors' remuneration. So we stuck in £120,000 for each year as being reasonable remuneration that they could expect to receive. So we then got an adjusted profit figures of 299 and 403. We applied a weighting of 2 and 1. And as you can see, the weighted average came out at, we said, £369,000. So then we look at how we arrive at the enterprise value. We've got the maintainable earnings figure of 369. The PE ratio in this case, we applied PE ratio of 5.3, so that's nearer to the 6. But it was a techie type company with probably quite a lot of growth potential, so we thought we'd go towards the higher end of that. So the enterprise value is those two figures multiplied together, which we said, let's say that is 1.96 million. Back to minority discounts. This valuation was for an EMI scheme where 4 employees would each get less than 10% of the shares in the company. And it would only be on an exit. So we agreed with HMRC that restriction on exercise would give us a 15% discount. and the minority status would give us a 70% discount. So the total agreed discount was therefore 85%. As this was an EMI scheme, we've got to look at the actual market value that the shares, the option price is going to be granted at. The gross share value is 19,600 per share. Applying that agreed discount of 85%, the 70% minority status, 15% restrictions on exercise. The actual market value is therefore only 15% of the gross value, if you like. So that comes out at 2,940 per share. In addition to that, we have to look at the unrestricted market value, which we'll come on to, which ignores a discount for restrictions on exercise, which in this case was 15%. So the unrestricted market value is important as it restricts the total amount of options that can be awarded to an employee. Some of you will be aware, the value of shares that can be awarded under EMI cannot be more than 250,000 per employee of the UMV, or an overall limit of 3 million for the company. In this case, the gross value was 19,600 per share. The discount for restrictions on exercise will no longer apply because we're looking at unrestricted market value, but we still do get the discount for minority status. So in this case, the UMV is 19,600 at 30% equals 5,880. So we put all that in our Val 231 covering letter, report, etc. to HMRC, and lo and behold, we got a response. And don't you love HMRC? On a strictly without prejudice basis and without detailed examination, I can confirm agreement to those figures 2940 and 5880. So that's pretty incentivizing for those employees that are getting those share options, because obviously when there is an exercise, there's not going to be any discounts applied to what their proceeds are going to be. Excuse me. So it's quite a good incentive for them. Unless you've been off grid for a few months, you'll be aware that there's been some fairly major changes in the budget. Most importantly, probably for us, is the major changes proposed to business relief and agricultural property relief, where the limits are now, well, total limit of 1 million and then 50%, which substantially erode the benefits of the IHT reliefs that were available. But these changes don't come in until April 2026. So certainly we're seeing quite a bit of interest from families wanting to move assets around prior to April 2026 to take advantage effectively of the old rules rather than the new rules. A few other practical points. HMRC will only agree EMI valuations in advance. We have tried to get informal valuations where, for example, we might need to report something under pay as you earn if it's employment related securities. But no, they will only agree EMI valuations in advance. And to be fair to HMRC, those agreements or disagreements or whatever, usually agreements, I have to say, usually come back fairly quickly. usually within 2 or 3 weeks. So they are fairly efficient. Unfortunately, for other valuations, so if the company was issuing shares to an employee, you'd have to rely on HMRC's post-transaction valuation check service. Unfortunately, it's not an online service, so your application just goes into the general HMRC section, and it can take many months for them to respond to it. I mentioned a pay-as-you-earn issue, or a potential pay-as-you-earn issue that we had, and that was for an exercise in March 2024. So we sent off the post-transaction check to say, look, we need to know that you agree the valuation here, because if you don't, the employees are cashing in shares and there's going to be pay-as-you-earn due or income tax due on some of it. We didn't hear anything until October 2024, when they actually agreed to the valuation that we'd put forward. But I think that agreement was more out of embarrassment than anything else. But I think the key point here is it is important to get a professional and robust valuation at the outset, even if you can rely on HMRC to agree it at some later date. You don't want HMRC to be coming along in 6 months' time and saying, yeah, we know you said it was £100 a share, we think it should be £500 a share. So I think having a good method of valuing and something that is tried and trusted, something that HMRC can see has been looked at and not just thrown together, is quite important. And I think on that note, short and sweet, it's basically thank you for your attention. And have we got any questions?
Yes, we've got a couple of questions here, Clive. First one is, if the company issues shares to an employee, how is that reported or taxed?
Okay. Yeah, if the shares are just being issued by the company, then those shares will have a value. So again, it would be important to get the evaluation done to say, right, we're valuing these shares at whatever value. So if you're issuing 5% of the shares to one employee, you'd look at the value of the company. But if it's a trading company, we'd be back to looking at the enterprise value. And then if it was a 5% holding, we'd be applying discounts of up to, say, 70% and saying, right, so this is the value. You'd probably put that on a P11D, unless the employee was actually paying for the shares, which is sometimes done via a bonus. So the employers say, look, if it's £5,000, we'll give you a 10 grand bonus, and you can pay it out of that. So that does happen. Any share scheme or scheme to employees is employment related securities. So there is some reporting to be done after the end of the tax year on a specific HMRC form.
Next question. Is there any institution in the UK which provides P/E ratio?
There are some trade journals that you can pick information from. Can't think of the name of one off the top of my head. But whoever's sent that in, I can find out what that is, because I've used it fairly recently, but I just can't remember the name.
Yeah, no problem.
Yes, there are. You are able to get PE ratios. I mean, on obviously on public companies, you can just get that off the internet. from any on any company.
Another question is, apart from EMI share options, what other share schemes are popular?
I would say the most popular ones are going to be growth shares. A lot simpler to set up than say an EMI scheme, because you don't need all the legal paperwork. So in the example we've just been through, we had an enterprise value of, well, roughly 2 million, something like that. So they could just as easily have put in a growth share scheme to say to the employees, right, on a sale, you can participate in any value over and above 2.2 million or whatever hurdle rate you want to set. And it's up to the employer to say, we'll set that rate at your shares come are 10% of whatever the value is above 2.2 million. So obviously if they're going to sell out for millions and millions, that's quite attractive. Again, we're down to post-transaction valuations and trying to get something agreed with HMRC. So sometimes a bit of a painful process, but usually we do get HMRC don't seem to challenge growth shares that much, as long as they're done on a reasonable basis.
Another question here is, what are your views on employee share ownership trusts?
My view is that they're going to be increasingly popular, given the changes to CGT that dear cousin Rachel introduced. They've already gained in popularity over the past few years. Obviously, from the seller's point of view, is no capital gains tax. It's just the practicalities of employees owning shares. And I should have mentioned, when we're saying what do you need a valuation for, an EOT is certainly one where you need a share valuation that's fairly robust. We'd send that into HMRC. They won't actually agree the valuation, but they will agree that it's not a transaction in securities and that it is a capital gains tax transaction. But certainly the most recent one we've done, the EOT was basically the sensible option for this guy, because he was the 100% shareholder. His sons had no interest in the business at all. He didn't want to sell it to a trade competitor. He had about 40 or 50 employees, so it made perfect sense for him to sell to the employees at somewhat of a discount. We think we came up with a value of 12 million, and I think he ended up with 11, something like that. So we applied a slight discount. Lots and lots of paperwork and lots of legal fees and professional fees in setting up an EOT. But obviously, there's a significant capital gains tax savings, so it is worth it from that point of view. But yeah, a lot of red tape to get through on those type of things. Any more for any more?
Yeah, just one more. Do you know which source HMRC uses to determine PE ratio?
I don't actually, no. They would have access to the same information everybody else has access to, I would say. But what I would say is that the vast majority of valuations that we're sending in, or accountants generally will be sending in, for unquoted trading companies. So the PE ratios, whichever one you've been guided by, whether it's Vodafone or whoever, it would be so heavily discounted. HMRC would, at the end of the day, look at what is a reasonable PE ratio for this business, given its profit trends, etc. I think certainly for EMI schemes, they don't tend to look too critically at the valuations and the PEs, as long as it's pretty reasonable. Other transactions they may, particularly where you're gifting shares or something like that. So yeah, I'm afraid I don't know the answer to that. We could try and find out.
Just got time quickly for one last question. Please do keep sending your questions in. If you use the comms@etctax.co.uk, and we'll be happy to answer anything. It's just I'm just conscious of time, so we'll just take this last question. But like I said, we are happy to take any more questions offline. The last question will be: how do you know how much discount a PE ratio is for a private company?
Sector, and it depends on the type of company that you're looking at. So, for example, if you were looking at the PE ratio of a property development company that was quoted and a roofing contractor, then you'd probably discount it by 70 or 80% anyway from whatever that PE ratio was. It is subjective. But as I say, you end up with a PE ratio that looks reasonable in all the circumstances to arrive at what is a reasonable enterprise value for the business. The methodology of how you get there is can vary quite a lot, but essentially that's what you're looking at. So you're basically sense checking what you end up with. So if you're ending up with a PE ratio of 10, you've probably got something wrong somewhere in looking at a public company with a PE ratio of 27 or something like that. I mean, there are some outrageous PE ratios out there, so you just got to be careful what you're looking at and why.
Thank
Okay.
you. I think that concludes the questions. Thanks, Clive. If you just want to move to the next
Yeah.
slide, please do follow us
Yeah.
on Eventbrite to keep up to date with all our webinars. It'd be great to see you all on our next webinars. Thank you very much, and thanks so much again, Clive.
Okay, it's a pleasure. Thanks, guys.